The United States is currently witnessing a boom in foreign direct investment, FDI, following the pandemic, driven by a resilient economy and new industrial policies. However, notably absent from this growth is Chinese companies. Examining the latest data on China's FDI in the U.S. reveals a significant decline in investment and a shrinking footprint, indicating a shift in economic policies and growing U.S.-China economic decoupling. This note outlines the key findings and implications of this trend. 1. Slowing investment. Chinese FDI in the U.S. has experienced a considerable slowdown since 2017. Annual investment has dropped from $46 billion in 2016 to less than $5 billion in 2022. China has transitioned from being one of the top 5 U.S. investors to a second-tier player, surpassed by countries such as Qatar, Spain, and Norway. 2. Shrinking U.S. footprint. Not only has investment slowed, but assets, revenues, and employment at Chinese companies in the U.S. have also declined. This decline is more severe and prolonged than the temporary slowdown experienced by other multinational corporations during the pandemic. It suggests that Chinese companies retreat from the U.S. market as a result of restrictive economic policies fueling U.S.-China economic decoupling over the past 5 years. 3. Declining job creation. The decreasing local job creation by Chinese firms further weakens political support for U.S.-China economic engagement. With fewer prospects of Chinese firms becoming major local employers in the U.S., local officials and businesses are less inclined to stand against more restrictive U.S. economic and national security policies towards China. 4. Risks of fragmentation and political misalignment. The retreat of Chinese firms from the U.S. underscores the risks of fragmented global value chains and misalignment of policy priorities between the U.S. and important allied nations. Chinese FDI has remained more resilient in other markets with lower regulatory and political scrutiny. The varying trajectories of Chinese FDI across OECD countries, particularly in high-growth sectors like electric vehicles, illustrate these risks. Conclusion. The decline in Chinese FDI in the U.S. since 2017 can be attributed to both Chinese policies and more restrictive U.S. policies. While Chinese exports to the U.S. continue to grow, Chinese companies' physical presence as investors and employers in the U.S. has shrunk. This trend has tilted the scale towards more restrictive economic policies towards China and diminished incentives for pushing back against such policies. Globally, the withdrawal of Chinese firms from the U.S. economy highlights the risk of an increasingly fragmented global economy, particularly in high-tech sectors. The divergence in Chinese FDI patterns among different countries may lead to transatlantic tension and impact job creation. Monitoring the convergence of U.S. and allied nations' approaches to Chinese greenfield investment will be crucial in the long run.